Accumulating wealth through investing in equity or stock is no longer reserved for the wealthy and the rich. Thanks to discount brokerage firms that offer zero commission trade, like Robinhood, Fidelity, Charles Schwab, M1 Finance, etc., investing for our future has become easier, has become accessible to all of us. Today, I'm talking about how we can leverage dollar cost averaging and time in the market to grow our wealth. We may not be millionaires, but for sure, investing in equity in the right funds, in the right company that you understand, can make you wealthier than when you started. Before fractional shares were available to the masses, retail investors like you and I, if you want to get into WU ETF, which track S&P 500, we need to have the full amount to buy one share or more. So $624.78 just to buy one share of WU. But with fractional shares, we don't have to have the full dollar amount for one whole share or two whole shares or three whole shares. We can have just $50 and get a fraction of the share. This way, we can still enjoy the growth of the ETF or in growth of the company that you know and understand. Instead of having $259 to buy one share of Apple stock, you can have $50 and buy a fraction of one share and enjoy the growth of Apple. Keep in mind, this episode is not meant to be recommending a stock or any fund. I'm only trying to showcase how dollar cost averaging and time in the market can grow your wealth. I built this sheet to prove that point of dollar cost averaging and time in the market. In this example, person X deposit $50 to invest in the individual taxable brokerage account since February of 2016. The reason I picked that date, that's when I started my investing journey with Robinhood. And this person decided to sell it today, April 10, 2026. So 10 years of investment. With dollar cost averaging, what it means is for $50, this person can buy WU, WOO, which is an ETF that tracks top 500 US companies. With $50 back in 2016, WU was $178 per share. That bought this person 0.279361 shares. And then the list goes on. So each week, every Friday, the purchase was made, just $50 per week. And if I scroll all the way down, on April 2nd, the share price was $602.99. So the person get less shares, but the person is still purchasing $50 worth of WU. With 528 weeks of dollar cost averaging, $50 per week going to WU, WOO, the person acquired 83.47 shares of the ETF. The cost basis, just a fancy term for how much it costs person X to acquire all those shares over those 10 years. So the cost basis is $26,400. When the person sells it today, the total value is $52,115.96. That's a realized gain of $25,715, profiting 97%, almost double the money. What about WTI? WTI is total stock market, tracking all publicly US traded companies. The same deals applies. $50 per week, and every week a purchase was made and a fraction of shares was purchased. And over the 528 weeks, the person acquired 150 shares with change. Still costs the person the same amount, but now the person realized gain is $24,173, and the return for the 10 years is at 91.57%. Still pretty awesome. Almost double. And the nice thing about WU and VTI is a broad-based ETF, exchange traded fund. And they have top 500 US companies or all US publicly traded companies. Investing in a broad-based fund like that, it's very safe. Yeah, there's going to be ups, there's going to be down, but over time, you're going to enjoy 8 to 10% return. What about Google? Over that 10-year period, Google returned almost a little bit over 3 times your money. So a profit of $81,000. What about Costco? I love to shop at Costco. People that work there love to work there. Look at Costco, just a membership warehouse, right? Double your money in that 10-year period. What about Apple? Look at the profit. What about Nvidia? With the same $26,400 over the last 10 years, the sale proceed is $809,000. That's a realized gain of $782,000. Look at the percent return, almost 3,000%. What about AMD? So far, I showed you ETF that give you a pretty good, decent 8 to 10% return, as well as individual company that has been growing quite well over the last 10 years. But the downside to individual company is if you don't like to research the company's financial, you don't understand the business, you don't understand their total addressable market, you don't understand where they're at in terms of their growth, you could be buying a company that's on the high, on the way down, and you could be losing your money. So I don't advise you to invest in individual companies unless you are willing to spend time to do your research, willing to sit down and listen to quarterly earnings. And if you're not keeping up to date and just simply listen to your boss, your coworkers, your friends, and your family, by the time they come back to you and give you the update, your money could be long gone. So investing in individual companies is awesome. It gives you high return, but it can also generate high risk. It's important that you don't just follow someone blindly. However, with ETF, exchange traded fund, that track the broad market, the broad base like top 500 US company or total US companies, that's a little bit lower risk. The chance of them going down to bankrupt, we have a bigger problems on our hand. Here's why you don't listen to stock buying tip, especially on individual companies. Look at Disney. If you were to invest in Disney over 10 years, you lose $3,000 or 11% of what you put in. What about Under Armour? You would lose almost half of your money. And then Nike, we all know Nike. Oh, wrong ticker. Nike almost half as well. To recap, with dollar cost averaging and time in the market, with just $50 a week over 10 years, you can accumulate double your money with just broad-based ETF in VOO, top 500 US company, or VTI, to all US publicly traded company, which returns a still very respectable return, almost double your money. You can't complain about that, right? And if you are willing to research individual company and know and understand the company, their financial statement, their management, their growth, their profit, where they at in their growth story, and keep up with their quarterly updates, if you're willing to do all that research, individual company can be a good investment, but it can also be a poor investment if you don't understand the industry, if you don't understand the business model, and you don't understand the company itself. Keep in mind when you sell stocks or ETF in a taxable brokerage account, you have a taxable event. And how they're taxed is depending on how long you held the security. I know I went over the financial jargons and terminologies fairly quickly. And if you don't understand it, no worries. I will have future episodes that will explain it to you so that when you're new to investing, you have a firm understanding what those terminologies mean. In this video, I just want to convey to you how dollar cost averaging and time in the market can make you wealthier. You may not be multimillionaires, but you will certainly be wealthier than when you first started. And when you accumulate enough wealth, and that enough is different from person A to person B, then you have the freedom to choose where to work, when to retire, when to pursue your passion and purpose. Where work is not have to, but get to. Or you can just simply enjoy vacation and do what brings you joy and fulfillment without having to worry about having the active income to support your life necessities and wants. After all, that's what we work for. You know, we have different phases of life. We have a phase of learning, earning, and returning. I borrowed that from Denzel Washington. And I'm very fortunate that I get to be in the phase of returning. And I hope that you can transition from learning to earning and returning, or just simply vacationing.